Okay, Assalamualaikum warahmatullahi wabarakatuh. And chapter 11, this foreign exchange. So we're gonna make this into the slideshow. Foreign exchange market, currency, foreign currency trading, and so on. Here, types of foreign exchange transaction, interbank trading, forward and futures market. You have to understand the difference between the two, and exchange rate determination. I think that the last part is very important. And continue with forward market, arbitrage, and so on. Okay, foreign exchange market is an organizational setting in which individuals, businesses, governments, and banks buy and sell foreign currencies and other debt instruments. Largest and most liquid market in the world. So dominated by four currencies: US dollar, euro, Japanese yen, and British pound. And please someone record for me. Otherwise I have to get out from this slideshow. Three largest: London, New York, Tokyo. Three functions at three levels. Okay, transaction between commercial banks and commercial customers. Domestic interbank market conducted through brokers. Active trading in foreign exchange with bank overseas. There are three levels: commercial bank and commercial customers, interbank market, and trading in foreign exchange with banks overseas. And so banks typically engage in three types of foreign exchange transactions, which is spot, forward, and swap. So spot, foreign exchange bought and sold for delivery immediately on the spot, which is usually the second day of business, or immediately, but can be second day of business. So spot transaction, outright purchase or sale of currency now as in on the spot. Spot dealing, simplest way to meet currency requirements, but carries higher risk of exchange rate fluctuations because there is no certainty of rate until transaction is complete. Second, forward transactions. So receiving or paying an amount of foreign currency on a specific date in future months, 2 years from now. Fixed, exchange rate is fixed now to be received or to be paying in the future. That's for forward transactions. So protect against unfavorable movements in the exchange rate, but will not allow gains to be made, and should exchange rate move in one's favor. So import-export. Usually we can do this forward transaction to avoid from the fluctuations of the currency exchange. So forward market next. So this in the forward market, foreign exchange bought and sold for delivery at future date exists mainly for widely traded currencies. US dollar, main currencies only. The third one is currency swaps. You swap, you change. Conversion of one currency to another currency at one point in time. Agreement to reconvert it back to the original currency at a specified time in the future. Will get back the same, will pay back the same currency if you swap 10,000 with 15,000 Swiss franc at certain date in the future, you'll get back your $10,000 and you pay back 15,000 Swiss franc. Plus minus with the so the rates, the rates of both exchanges agreed to in advance involve single transaction in which traders agree to pay or receive stipulated amounts of currencies at a specified rates. So this is example. This is just amount, global distribution of foreign exchange transaction 2016. Average daily volume, billion of dollars. 48.6% are foreign exchange or currency swaps. Almost half involve currency swaps. Spot transaction 32%, forward transaction 13%, foreign exchange option 5%. Okay. Now, interbank trading. Remember the three functions, three level? Yeah. Foreign exchange market functions at three levels. One of them is interbank market. So we're going to look at the interbank. So interbank trading, retail transactions, bank purchases from and sales to customers, less than 1 million currency units. Wholesale transactions, compared with retail, this is wholesale, bigger amount, more than 1 million currency units between banks or with large corporate customers, not with the regular Tom and Jerry customer. Interbank trading. So Citibank, share of the foreign exchange market. Earning profits in foreign exchange transaction on 24-hour basis. So bid rate, price that bank is willing to pay for a unit of foreign currency. Offer rate, price at which bank is willing to sell a unit of that foreign currency. So that's the spread between, the difference between bid and offer rate. And that's how banks make money. For example, if you want to go travel overseas, you need US dollar, 450, let's say 450 now, so for the offer rate by the bank, you may have to pay 450, 460. I'm just making up, okay? Or 455. You have to. That's the offer rate by the bank. The price at which the bank is willing to sell that dollar for you. You want to get a dollar, you have to sell your ringgit to get the dollar. So instead of 450, you have to pay like 455. That's when you want to go overseas. You need a dollar. Now you have come back, return to the country. You don't need the dollar anymore. So you want to sell the dollar, get ringgit. So now you get in the bid rate. Bid rate, instead of getting 455, you're getting only 450, 445 only. That's the bid rate. So big difference between the two. from my example, that's the spread. So a bank's bid quote is always lower than offer quote. That's how the bank make profit. So exchange rate, price of one currency in terms of another, number of units of foreign currency required to purchase one unit of domestic currency. Foreign exchange rate reported mid-range between bid and offer prices. The example I gave, mid-range. I'm just making up, okay? 450. Bid rate I gave just now, 445. Offer rate, 455. I'm just drawing a simple example, okay? Mid-range between, that's the exchange rate reported between the two, bid and offer. So currency depreciation, more units of a currency, national currency required to purchase a foreign currency. For example, yesterday, I need 450 to get a $1. Today, I need 455, 4 ringgit 55 to get the same $1. So Malaysian ringgit has depreciated. The opposite, the story would be. Yesterday, I needed only 450 to get a dollar. 4 ringgit 50 cents to get a dollar. Today, I need only 445. Less. So that ringgit Malaysia has appreciated. So cross exchange rate between any two currencies, such as between Swiss franc and British pound. Cross exchange. So foreign exchange can be bought or sold for delivery immediately, spot market, or in future, forward market. Foreign exchange can also be traded in futures market, can be traded. So parties agree to future exchanges of currencies and set applicable exchange rates in advance. Only some leading currencies traded, not all the currencies in the world, the main currencies only. So trading takes place in standardized contract amounts and in specific geographic location. London, New York, Tokyo. So forward and futures market. So the difference. So this table you can see the difference. So forward contract on the left, futures contract. Okay. The issuer, forward contract, commercial bank, futures market, international monetary market, or the Chicago Mercantile Exchange and other foreign exchanges such as the Tokyo International Financial Futures. So forward market, futures market. Forward market, for example, you want to export your products. You just want to make sure that, you want to avoid, okay, if I export I'll export my product to the US and I will get US dollar. Okay. Now it's 450, 4 ringgit 50 cents. I will make sure for me, I'll get at least 450. I don't want to get 4 ringgit. Because to me, what is most important for me, I get back my money. I'm exporting now in US dollar, of course. I will get back. I'll be paid in US dollars also. Of course, I'll be paid in US dollars. So now, every $1, I know I get 4 ringgit 50 cents. I want to make sure I will get at least 450. I don't want to get 4 ringgit, 430, 445, even 4 ringgit 49 cent, even 1 cent. Because if a lot of amount, if I export a lot, even 1 cent makes a difference, okay? So I want to make sure that, so I'll get into the forward contract with the, the issuer is commercial bank. So trading is over the counter by telephone, forward. However, futures on the IMM market floor, contract size tailored to the needs of the exporter and importer. Just now I was an exporter, okay? That one standardized in round lots, not set by size for the forward market. Delivery, my battery, sorry, low. Delivery negotiable, futures only on particular dates only. Contract cost based on bid and offer spread, futures brokerage fees. Settlement on expiration of dates only at a pre-arranged price. Futures profit or losses paid daily at close of trading. So IMM, the futures market, okay? On the right, futures market. Chicago Mercantile Extension of Commodity Futures Market. Size of each contract on the same line as the currency's name and country. First column, maturity months. So this is forward and futures market. So I'm just showing, okay? Let's go. So, and open price at which currency first sells when IMM opens in the morning. Let's open. Open, high, low, settle, change, open, interest. So Japanese yen. High, contracts highest price for the day. Low, contracts lowest price for the day. Settle, contracts closing price for the day. So people make profits on, the high and the low, selling when it's high, purchasing when it is low. So change compares today's closing price with closing price as listed in previous day's paper. Plus means price has ended higher, minus ended lower. Open interest, total number of contracts outstanding. So option. So foreign currency options. So agreement between holder and writer, holder, buyer, and seller. Agreement between holder and writer. Holder has right, but not obligation to buy or sell financial instrument at any time through specified date. Writer has obligation to fulfill a transaction. So used by firms seeking to hedge against rate risk, the fluctuation in exchange rate. So using as a hedging. So also used by speculators seeking profits. So foreign currency options holder has right to buy or sell fixed amount of foreign currency at pre-arranged price within specified period, can choose which exchange rate to guarantee and length of contract. And then we come to the call option. Okay, we have here put or strike. So gives holder right to buy foreign currency at specified price. So put option gives holder right to sell, sell foreign currency at a specified price, strike of price at which options can be exercised. So premium is the fee received by the writer of options contract. Received by the writer. Who's the writer here? The agreement between holder, the buyer, and the writer. So premium fees received by the writer of options contract. So next we come to those are the markets. Now the most important part of our chapter 11. This understanding will make you understand of this part, okay? For our lessons in the coming chapters. So exchange rate is determined by supply and demand. That's the most important thing you have to know. Exchange rate determination determined by what? By the demand for foreign exchange and the supply of foreign exchange, with supply and demand. So the demand. Exchange rates is in free market determined by supply and demand. So demand for foreign exchange is derived demand, driven by foreigners' demand for domestic goods and services and assets. Driven by foreigners' demand for domestic goods and assets. So correspond to debit items in a country's balance of payments. That's why very important we have to understand our chapter 10, balance of payments. Correspond to debit. Varies inversely with price, the demand. Demand is downward sloping, okay? Demand. So supply of foreign exchange, amount of foreign exchange offered in the market increases at various exchange rates, all other factors equal. So upward sloping the supply curve, just like any demand and supply curve, same. Here it is. So here, so this is exchange rate. My cursor here, the equilibrium here. This is a balance of pounds. This is a dollar per pounds. So we plot the quantity of pounds, UK pounds, with the exchange rate here on the top, on the vertical, on the y-axis. Dollars per pound. Depreciation, if more dollar needed to get the 1 unit a pound, more is depreciation, less is appreciation. So here, demand for pound and supply per pound. So the equilibrium is here, $2 per pound. I think basically that's it. No need to explain anymore. So equilibrium rate of exchange determined by market forces of supply and demand. Increase in demand for products. Increase in demand for pounds, which is rightward shift of the demand curve. Shift. If more demand per pound, gonna shift the demand curve to the right. So dollar will depreciate. Is there another graph? No graph here. No next graph. So we can just put here the graph. More demand for the pound will shift the demand curve to the right. So we'll get to this, intersection here. Let's say 250. So that's depreciation. Depreciate. When there's more demand for foreign currency, your own currency will depreciate. How can that happen? When you import more from the, from the UK, you need more UK pounds. Or when you invest in the UK, you need more pounds to be investing in the UK. So dollar depreciates now. Decrease in demand for pounds will shift to the left. So let's do that by my cursor to the left. So let's say intersection here, equilibrium 150. 150 means less, which is opposite. Less is appreciation. So when less demand for foreign currency, your own currency will appreciate. How can that happen? When you export or when the UK citizens come to, in this case, to the US to invest. Say they will need more of dollar and less of pound needed or demanded in the country, in the US. So this picture is in the US, okay? Not in the UK. You gotta understand that. This graph tells about the US, in the US. So increase in supply of pounds, rightward shift, dollar appreciate. Okay, this now same. Same already. So advantages and disadvantages of strengthening and weakening of dollar. Okay, strengthening of dollar. What is the advantage? US consumers now see lower prices of foreign goods when dollar appreciate, strengthen. Number two, lower prices on foreign goods help keep US inflation low. Oh yeah. Can buy cheaper from overseas. So prices in the US, inflation is kept low. So US consumers benefit when they travel. Yes, that's easy to understand. Disadvantages. Number one, US exporting firms find it harder to sell. Not easy to sell. Harder to compete in foreign markets. Number two, US firms import competing markets find it harder to compete with lower priced foreign goods. Of course, more expensive. US goods more expensive. Foreign tourists find it more expensive to visit United States or US. Weakening of dollar, on the other hand. Advantages, now the dollar weakens, depreciates. US exporting firms find it easier to sell goods. Yes, because US goods is cheaper now, easy to sell, easy to export. Number two, firms in the United States has less competing pressure to keep prices low. Oh yes, because dollar depreciates. More foreign tourists can afford to visit the United States. That bring more income in the services. Part of the current account balance. Part of balance of payments, okay? Balance of payment is the big one. Within that, current account, capital and financial account, and all those omission, statistical discrepancy, and also changes in the reserve. And at the bottom, that will give the balance of payments. Disadvantage. US consumers face higher prices on foreign goods. That will reduce trade deficit. Because foreign goods coming out in more expensive. So higher prices on foreign goods contribute to higher inflation in the States. Yes. US consumers, when you import a lot of goods, that will contribute to higher inflations because foreign goods are expensive. So US consumers find traveling abroad more costly, yes. So exchange rate index, effective exchange rate or trade weighted dollar. So we're going to study about nominal versus real exchange rates. That's very important also to understand. What is more important is the real exchange rate. So weighted average of exchange rates between domestic currency and those of nations' most important trading partners. Weights determined by relative importance of nations' trade with each of these trading partners. So nominal. Average value of dollar not adjusted for changes in price levels in United States and trading partners. So an increase means the dollar appreciates relative to other currency. So loss of US competitiveness when appreciates. So decrease means depreciate, improves US competitiveness. Why? When the dollar depreciate, easy to export because products from the United States is cheaper because dollar depreciates. So improves US competitiveness. So this is exchange rate versus real exchange rate. With the index 1973 as in 100 based on March 73. So 100, so real exchange rate. Decrease means depreciates. But you can see the difference. Let's take the latest one, 95, the nominal, but it's the real is 109. The index, huge gap. So the major currency index includes the currency of the United States, Canada, Euro area, Japan, United Kingdom, Switzerland, Australia, and Sweden. Okay. Embodies changes in the price levels in different currencies, indicates average value of dollar. 110, okay. Average value of dollar based on real exchange rates. Real exchange rate is the nominal exchange rate adjusted for relative price levels. So increase in index indicates appreciation of the dollar. So the real exchange rate is the nominal multiplied by foreign currencies price level over home currencies price level. So this is adjusted by the price, the relative price level between the countries. So you look, if you look at this on the right, it's a relative term. Foreign countries price level in foreign country divided by your own country, home country price level. So it's a relative term, and you multiply that by the nominal exchange. So that's what you gotta know. Real exchange rate is adjusted for relative price levels. Not only price level, the word here, relative price levels between foreign countries' price level and your own country's price levels. Or you can put this home country price level to put at the bottom on the left, nominal price exchange rate divided by home country price level, multiple by foreign currencies price level, same. So next, arbitrage. Simultaneous purchase and sale simultaneously of currency, purchasing and selling of currency in different location, in different foreign exchange markets. Goal is to profit from exchange rate differentials in the two locations, to make profits from the differential. Eventually leads to identical price for some currency in different locations that results in one market. So 2-point arbitrage, two currencies traded between two financial centers. 3-point arbitrage, triangular arbitrage, three currencies and three financial centers, switching funds among the three currencies to profit from exchange rate inconsistency. So arbitrage is to make money, to make profits. Whereas forward market is different. Forward market, I explained earlier, to make sure you get your money. You want to cover yourself, to avoid yourself from the fluctuation in the foreign exchange. I want to make sure I get 450, 4 ringgit 50. What happened if Malaysian ringgit appreciates? For example, appreciate to 4 ringgit 45. The dollar I export this thing $10. I export to the United States $10. That my $10 has now become less in value term in ringgit Malaysia for me, because every $1 I get only, let's say, easy to instead of 450, 440, easy to hear it. Okay, 450. So 450 times 4 ringgit 45 ringgit only. I don't get my 50 ringgit. So that's forward market. It's not to make profit. But for banks, different. They make profits on the spread. Okay. But for exporters, I want to protect me from fluctuation. So forward market. Oh, this is forward market. Okay. Oh, yeah. So currencies bought and sold now for future delivery. Typically, for me, exporter. Okay. 1 or 3 or 6 months. So this is forward market. I was explaining forward transaction. I was explaining. But forward transaction also, there is a forward market. This forward transaction to be delivered in the future. I'm getting paid my $10 in the future at the agreed already exchange rate. So that's a way of protecting. But that's our also forward market. So foreign exchange bought and sold for the at future date exists mainly for widely traded currencies. So let's go back to here. What is it? For market. Currencies bought and sold now for future delivery, typically 1, 3 or 6 months. Exchange rate agreed to at a time of contract, yeah, during the contract. So payment made when the future delivery takes place. Banks provide this service to earn profits. Banks provide the service to get profits. But for me, as exporter, not for me to make profits. For me, as an exporter, to protect my income, my revenue. This $10, that I export to the United States will give me 50 ringgit. Say 450, 40, 45 ringgit. I don't want to get, 40 ringgit. So forward market, forward rate of exchange used in settlement of forward transactions at a premium when foreign currency is worth more in forward market than in the spot market at premium. So when you dealing with a bank, because bank make profits, this forward rate at a premium when foreign currency is worth more in forward market than in the spot market. Spot market 450 only. You contract with, when it's worth more than the spot market. Spot market 450. But what happened when at the delivery? So when foreign currency is worth more in the forward market. At a discount, when a foreign currency is worth less in forward market than the spot market. So forward rate, premium or discount in the bracket. Premium is when forward rate minus spot rate divided by spot rate times 12 divided by number of months forward in the contract. So, for example, here 109, 12, 1 month only. So 4.4%. That's the premium. That's how you calculate the premium when the foreign exchange value is worth more in the forward contract than the spot in the forward market than the spot rate. When foreign was more in the forward market than the spot market. So relative gains 120. I'm not sure time. Relative gains from interest rate differentials tend to be offset by losses on foreign exchange conversions. So, and reducing or eliminating the incentive to invest in the UK Treasury bills. So, here, to profit from relatively high interest rate in the United Kingdom, US investors will buy pounds with dollars on the spot market. So to invest in the UK. Why? To get benefit from the high interest rate in the UK. So you want to invest in the UK. Remember, money is going, fund is going where the interest rate is high. Unlike the floodwater, rainwater will go down where the lowest, elevation and flooding there, banjir. On the other hand, the opposite, money will go where the interest is highest or higher or highest. That's where money or fund is going, wherever interest rate is high. In this case, in the UK, high. So this US investors, American, will buy pounds using the dollar in the spot market. And then spot price of the pounds rises, say to $2.01 per pound because of buying. So spot prices now increase because of the demand. So pound moves to a discount in the forward market. And the relative gains from investing in the UK decreases. Okay. So relative gains from interest rate differentials tend to be offset by losses on foreign exchange conversion, thus reducing or eliminating the incentive to invest. So it gets back to the normal. So sell pounds for dollar in the forward market. For price of pounds fall, say to 100. So pound moves to a discount in the forward market, and thus reducing the incentive to invest in the UK. So managing your foreign exchange risk. Forward foreign exchange contract interest rates play key role. So now this is very important part of introducing what we're gonna study in the next chapters. Interest rate is the most, one of the most important key in all this, in the flows, inflows or outflows of money, of funds. So interest rate play key role in determining relative attractiveness of assets denominated in domestic or foreign currencies. So exchange rate fluctuations can substantially change returns on asset denominated by in foreign currency, and can swarm effects of interest rate differential. So we're gonna see the interplay between interest rate and exchange rate. Sometimes we get confused because both are having the end, the tail, rates. So we're talking about interest rate and exchange rate. So managing your risk. Forward foreign exchange contract. This is forward foreign exchange contract. Continue. Firms and individuals can insulate themselves. Yeah, this is the word I wanted to use. I wanted to insulate myself from the ups and downs of the exchange rate. When I was talking, I'm an exporter. So firms and individuals can insulate themselves from volatile currency values by hedging, which is to avoiding or covering a foreign exchange risk in the forward market. Some firms do not hedge because rationalize that currency fluctuations even out over the long term. No need to hedge. Some firms. Depends which firm. Large firms usually hedge. Small firm like myself, maybe not. But I will certainly do the forward, contract, forward market, to insulate myself. So how? This is forward market. Merkel, this is the Chancellor of Germany, no longer. She steps down after so many years helming Germany. How Merkel, Volkswagen, and Nintendo Japan manage foreign exchange risk. Many hedge and convert cash when exchange rate most favorable. Hedge and convert cash when so smaller companies, Merkel can purchase forward contracts that guarantee bottom line. Yes, forward contract for a small company like me can purchase. I will not do hedging. Can purchase forward contracts that guarantee bottom line exchange rate regardless of actual. Bottom line for me was RM4.50. Bottom line. So does foreign currency hedging pay off? When currencies fluctuate dramatically, hedging may be too expensive. Some companies like 3M do not hedge, believing market evens out over time. So interest arbitrage, process of moving funds into foreign currencies to take advantage of higher investment yields abroad. So currency risk, unpredictable losses against returns from foreign investment converted from foreign to domestic currency. We have uncovered and covered. Uncovered interest arbitrage, when investor does not obtain exchange market cover to protect investment proceeds from foreign currency fluctuation. So this uncovered arbitrage, example, UK 3-month treasury bill interest rate, the rate is 10% per year, rate per 3 months 2.5, US 3 months treasury bill interest rate 6. So uncovered interest differential favoring the UK 4%. For the year, the rate for 3 months 1% favoring the UK. This is uncovered example when investor does not obtain. So let's look at the covered. This will reduce currency risk. So investor exchanges domestic currency for foreign currency at a current spot rate, uses foreign currency to finance foreign investment. So investor contracts in forward market to sell amount of foreign currency that will be received as proceeds from investment. So this is covered. So up to here 12, 6, okay, 6, 4, 1, 10, 6, 2.5, 1.5. Yeah. UK 3 months 12%, for 3 months 3%, US 8%, 2%. So uncovered interest rate differential probably UK 4%, 1%. So forward discount on the 3-month count minus 0.5. So covered interest rate differential favoring the UK at 0.5%. So because you have this here, the forward discount on the 3-month pound. $1.5 here. So forward discount at 0.5 here, so you're covered. So speculation attempts to profit by trading expectation of price of future, deliberate assumption of current exchange rate risk. So you know the 1997, 98, 1997, 1997 and 1998. So 1997 and 98, East Asian financial crisis, it's got to do with speculation about the exchange rate, beginning with the Thai baht dropping in the value, and then people starting to bring out funds from Thailand, and that was contagious, spreading that speculation to other countries, Malaysia, Singapore, Hong Kong, and so, until finally 3 countries affected went to the IMF to get bailed out, which is Indonesia, Thailand, and Korea. Malaysia chose its own way, just like Frank Sinatra, I do my way. Malaysia chose not to borrow from IMF, because when you borrow from IMF, you must do whatever IMF said you have to do. So Malaysia opted for currency capital control. capital control, plus pegging the ringgit Malaysia, 3 ringgit 80 cents for the 2 years. For 2 years. Okay. Long position, just a story I'm telling what happened in 1997-98. Long position attempt to realize gains from an expected appreciation of a currency. Short position sell high, buy low. So stabilizing speculation works against market forces by moderating or reversing the rise and fall in currency's exchange rate. Useful function for bankers and business that seek stable exchange rates. What about the destabilizing speculation, the one that I mentioned, what happened to East Asia, the currency crisis? So can amplify and reinforce fluctuations in currencies exchange rate. What happened when the baht went down in terms of value? The Central Bank of Thailand must stabilize it by creating demand for baht so that baht will not go down. How to create demand? By purchasing baht. Central Bank of Thailand purchased baht to create demand. Purchase baht using what? Using the reserve, which is dollar. So you use the reserve dollar, US dollar, to purchase baht. Same in Malaysia, use the reserve, which is dollar, to buy ringgit, to stop it from going down, falling further in terms of value. But you can do so much, until you finish all your reserve. And we don't want to do that, to finish out all your reserve. You must have a reserve to pay for imports. So, and that's when currency crisis happen. You gotta get help. So these countries, Thailand, Indonesia, and Korea, got help went to the IMF to seek help. But Malaysia used Malaysia's way. So can disrupt international transactions by impeding trade and disrupting investment. Yes. So foreign exchange traders, okay, this is another topic. Okay. Foreign exchange trading as a career, I don't want. For me, I don't want. Foreign exchange traders are hired by commercial banks, companies, and central banks. Study factors that affect local economies and rates of exchange rate, then take advantage of misvaluations of currencies by buying or selling in different foreign exchange markets. Do you really want to trade currencies? Only 15% of day traders realize profits. Oh, that's the end of it. Oh, I didn't know. So, any question? What time is it? 1:36. So, let me stop here and stop recording for a while. Click exit. The thing is that I want to highlight to you, we've lost 2 weeks when the relief period for flooding, 2 weeks, and the academics does not shift the exam dates. They just let us to use the 2 weeks of the break, while in fact it's only 1 week break because there's Chinese New Year. Chinese New Year, you know, we have the Monday working, but no one is working actually in Malaysia. If there's a big holiday in the country on Monday, if you know that holiday falls on Tuesday and Wednesday, the 2 days holiday, okay, officially. So Tuesday and Wednesday. So Monday is like, so basically what I'm trying to say is that actually we have 1 week only, not 2 weeks. So I wish that the academic shifted really the exam dates 2 weeks. Everything has become 2 weeks shifted at UKM. I wanted that to be that way. So the implication is that from this week, what I'm trying to do is that everything must finish before the Chinese New Year, except the interactions, which I'm beginning to put now. I wanted to put during the banjir, during the flooding, but I thought I shouldn't. So a number of interactions on LinkedIn and also on my YouTube. So that will put the interactions, and all the chapters from now. We just finished chapter 11, so definitely group 11 must prepare for next week's presentation, but that's not the end of it. Chapter 12 is already on my YouTube. Chapter 12, 13, 14, 15, 4 chapters already on my YouTube. So you can watch my YouTube for the full lecture, because all those YouTube cover the full lecture of each chapter. What I will do this week, I will conduct a lecture on themes, which I cannot require you to attend, because I cannot force you in terms of what do you call this attendance. I cannot force you to attend. I cannot take the attendance. I will do a lecture on themes to summarize chapter 12, 13, 14, and 15. So looks like I may be able to cover 12, 13, 14, 15, 4 chapters in one go. So I will find that time, maybe not tomorrow or the day after tomorrow. Tomorrow, Wednesday, or maybe Thursday. So what I'm trying to get the point, okay? Definitely group 11, which the chapter finished today, must prepare. Group 12 also must prepare. Group 13, 14, 15 must prepare. So you better wait for my guidelines. Hopefully tomorrow, I give all the guidelines for chapter 11, 12, 13, 14, 15. 5 chapters. The guidelines. Inshallah, by tomorrow, I get the 5 guidelines, 5 chapters. And we'll see. You must prepare. Hopefully, we can present the five groups in one go next week. So that we can finish early. We don't want to drag into the week of Chinese New Year. You gotta understand that the academic give you 1 week, and that the second week is Chinese New Year. And we should be finishing before that. And I remember there's a video that you must do, group video. That one no need to present, just the video, because we will not have time for that. And let me say to you right now, our final exam will cover chapter 10, 11, 12, 13, 14, 15, 6 chapters. And the format is multiple choice, A, B, C, D, and true and false. All multiple choice basically, because the true and false is A is true, B is false. We have A, B, C, D, right? So A true, B false. So 14. Since we are in class, so I should go to chapter 12 as much as I can. Then I'll go again for the whole 12, 13, 14, 15 in my lecture. Hopefully that my lecture will be, tomorrow, or tomorrow or the day after tomorrow. So now it's chapter 12 for the 15 minutes or so we have. Now, we've learned in chapter 11 the supply and demand of foreign exchange determine the exchange rate. So this chapter expand on that. Exchange rate determination. What determines exchange rates? Determining long-run exchange rates, inflation rates, purchasing power parity and long-run exchange rates, determining short-run exchange rates, the asset market approach, foreign exchange rate overshooting, forecasting. So what determines exchange rates? Factors that cause the supply and demand schedule of currencies to change, Number one, market fundamentals, which is the economic variables, productivity, inflation rates, real interest rates, consumer preference, government trade policy, and market expectations. So the factor that's determine the exchange rate is, there are two main factors: market fundamentals, fundamental of the countries, economic fundamentals of the countries, and expectation, news about future market fundamentals, news about that fundamentals. In the news you read this and that, so people do expectations. So traders' opinion about future exchange rates. There are short run, medium run, and long run factors affecting exchange rates. Short run, transfers of assets, bank accounts, and government securities that respond to differences in real interest rates and shifting expectations of future exchange rates. Transfers of assets. Medium run is the cyclical factors, cyclical fluctuation in economic activity. The economic activities, construction, up or down, production of economic sectors, manufacturing, mining, construction, all those. I've just given one, construction already, wholesale, retail, and so on. All these cyclical fluctuations in economic activity. That cyclical can be a factor of seasons and so on. Long run, dominated by flows of goods and services and investment capital that respond to inflation rates, investment profitability, consumer taste, productivity, and government trade policy. Open, high tariff or low tariff, liberalized or not. So short run, only short, so transfer of assets that respond to the differences in real interest rates. Why differences? Money or funds will go, assets, funds, will go where the return is high. Where the return is high, where interest rate is high. So medium and cyclical, long run, all these fundamentals. The long run is dominated by the fundamentals of the country, economic fundamentals, inflation, productivity, high or low. So what determines the interest rate? All this. So in this graph, this is fundamental equilibrium path time against traded value exchange rate. 9 minutes left. In the short run, there can be short run, overshooting path, overshooting from the fundamental equilibrium path, the wider one. Fundamentally driven medium run cyclical path. Fundamentally driven long run equilibrium path. This the thick one, long run. And this is medium run. But the short run, this is short run, can overshoot. This we call overshooting in the short run. So by long run, structural, medium run cyclical, and short run speculative forces. In the long run, exchange rates, reactions of traders in foreign exchange market to changes in the 4 key factors in the long run. Relative price levels, relative productivity levels, preferences for domestic or foreign goods, people in that country, whether they prefer to consume goods produced domestically or to import, prefer to use imported goods. That's preference. Trade barriers, high or low tariffs, protection or not. So, factor, price level. If increase price level in the United States, the dollar will depreciate. Price level increase, dollar will depreciate, the effect on dollar exchange rate. On the other hand, decrease and price level appreciate. US productivity, increase in the productivity will appreciate, the dollar will appreciate. Decrease on the other hand, depreciate. So preference, increase preference for imported goods. Okay, let me add there, because what preference? US preference increase for imported goods. Americans like to buy goods from overseas. This will depreciate US dollar. On the other hand, if Americans are no longer crazy about imported goods, this will appreciate the dollar value. US trade barriers, increase in trade barriers, more tariffs, so will appreciate the dollar value. Decrease will depreciate. What happened when decrease? More imports easily coming into the United States. So more imports coming will depreciate the dollar value. So productivity, we look at one by one. Looks like we look at number 2 first here, productivity. So increase in US price level, yeah, even though the title productivity, but talks about the price. Okay, yeah. So price, productivity, preference, trade barriers. This is in the long run, okay? Yeah, we're talking about here long run. Short run is transfer of asset. You got to understand this clearly. Short run only transfer assets. Cyclical, medium run, cyclical. Long run will be affected by inflation, which is price levels. Okay, inflation is price levels, investment profitability, consumer taste, and preference. Just now, import or export, productivity, government trade policy. So this, go back here. Increase in US price levels will lead to increase in demand for foreign currency. Decrease in supply of foreign currency and depreciation of the dollar. So increase in demand for foreign currency, so depreciation of dollar. Chapter 11, we saw the graph. Demand for the pound shift to the right will depreciate the dollar. Remember previous chapter? 3 minutes left. Decrease in US price level will lead to decrease in demand for foreign currency. Why? Price level goes down. Everything in the United States is cheaper. Goods is cheaper. Easy to export. When easy to export, more export, less demand for foreign currency. So dollar appreciates. it's gonna lead to appreciation of the dollar. So preference for domestic offering, increase demand for US goods, appreciate the dollar, yes. Increase demand for US imports, increase demand for US imports, depreciation of dollar. So easy to understand, increase demand for US export, export more, export more, export more, export more, export, US export more. So appreciate the dollar. US impose trade barriers, not easy to come. The goods not easy to come into the United States. Appreciation of the dollar, meaning less import. Not easy to come, less import. Dollar appreciate. So we have to stop at that because there's no time for me to go through that graph. We have 2 minutes left. So I'll continue in my own lecture. Plus I have to make it this bigger. How to make it bigger? So small. Okay, thank you. And I'm gonna, my mouse not working. How to get out? How to get out? Oh, escape.